Hello, everyone, and welcome to today's Investment Manager Showcase, presented by our sponsors, Nuvama Asset Services, Deloitte, KFintech, and LSEG. Investment Manager Showcase is a first of its kind video series designed to showcase pre-selected smart investment opportunities that have the potential to offer return on investment. Today, we're diving into the world of commercial real estate investments, and we're thrilled to have with us Mr. Mitesh Agrawal from NovumLake Partners. NovumLake Partners is a real estate investment and asset management platform focusing on data centers and tech parks office verticals in India. And Mitesh comes with over 25 years of experience and has shaped Novum Lake Partners into a trusted institution in Indian real estate. So Mitesh, I'll let you take over. And if you have any questions, please drop it in the chat box. So we can, take it at the end of the session. It'll be a 25-minute session, and then we can have the floor open for questions. Over to you, Mitesh.
Okay, great. Thank you, Namrata, for the opportunity. And so I have a presentation which I will try and put it on the screen, roughly like a 25-minute presentation followed by Q&A. Okay, great. I'll start with a very quick background about myself. So I've been in real estate investing for about 20 years now. First 15, 16 years with a fund called Nuvama Capital. It's a US-based fund, and I was heading the real estate investments team. We used to invest in commercial real estate. And roughly 4 years back, I started NovumLake, which is a unique real estate platform for India. I started with one of the first distressed, insolvency trades in the country and took it out of insolvency. So overall, 20 plus million square feet of transaction experience for me in institutional real estate in the country. And roughly 20% plus IRR is what we've been able to deliver since the last two cycles, which is 2012 onwards. And importantly, not lost money on any single investment till date on the office real estate investment side. So that's a very quick background, and would like to delve deeper into in terms of what are the kind of work we've done in the commercial real estate side. The industry is, of course, a very old one in terms of buying commercial real estate, leasing it to tenants, and earning appreciation. But there are very interesting facts of it that we've been able to pull together in terms of a business strategy. So this is about how we started at NovumLake as a platform. So this is the first investment, first transaction, which we did at NovumLake, which is roughly 3.5 years back. This is one of the first insolvency acquisitions in the country. This is an asset called Prius Platinum, which is located in New Delhi, Saket district center. So superb location in South Delhi. And the asset was an office building which was completed, but it had become vacant because of insolvency and mismanagement. So NovumLake was a resolution applicant under insolvency, and we won the bid for roughly around 425 odd crore rupees. And we had very high quality equity partners in this. And so we won the bid, we funded the transaction, took over this particular asset. We put together a great operating team to lease the asset, to improve this asset, and a lot of effort went towards operational turnaround of the asset, which included things like getting LEED Platinum certification for the building, renovation, complete repositioning of the asset, creation of amenity spaces, and creation of a lot of landscaping areas in the building. As a result of that, we were able to increase the occupancy for this building from 30% to 100% today, with very high quality tenants, which has resulted in almost like a mid-20s IRR to our investors. We've been able to return 80% plus of our capital back. So this is a case study of actual work done on the buy, fix, sell model, which is quite prevalent in US, and which is a great source of returns for investors, which is really not predicated only on market growth. Essentially, a lot of the value has been created by buying under distress and then leasing out the asset and operational turnaround, which is really not dependent so much on the market forces. So that's the kind of work we've done in the past, and we want to aspire and do more such transactions and funds in future. And with this background, I will take a step back and again sort of see how the commercial real estate sort of really fits into the investment portfolios for investors. Uh, so of course, we have equity as a big, large asset class for investors, and a lot of the investors have had very high returns in the recent past, last 5 to 7 odd years. But many investors want to do asset allocation, given where equity valuations are, given volatility and things like that. So really, something like commercial real estate fits into the fixed income spectrum of things, where they're comparing it to either traditional fixed income products up or things like private credit funds. Uh, so if you see the matrix of yield versus growth, you have a lot of traditional products like fixed income, liquid mutual funds, right up to private credit funds, which would give you high yields, but typically held to maturity, there would be no capital appreciation. And on the other end of the spectrum, you would have products like gold, which would be no yield and all capital appreciation. So essentially, there is space for something like commercial real estate investment, which promises a good return on a yield basis, as well as offers capital appreciation on the asset as well. So that's really where commercial real estate is fitting into the investment portfolio for investors, because there is a need to balance both capital appreciation and yield. So that's one factor. The other important factor is on the taxes side. What has happened is that post 2023 budget, practically almost all fixed income products get fully taxed on a marginal rate basis, which is almost like a 39-40% tax for individuals in the highest tax bracket. And therefore, if a product like commercial real estate under AIF is able to offer taxation, which is on a long-term capital gains basis, which in the current budget of FY of 2024 has come down to 12.5% tax rate, becomes very interesting proposition for investors on a post-tax basis. So those are the two real factors where essentially we are combining yield plus growth on the return side. And secondly, on the tax side, it is far more efficient for investors. Within the gamut of real estate, investors have multiple options. So this is important to understand as to where a product like this is fitting into the real estate scheme of things for investors. So of course, there could be either commercial real estate as well as, or there could be residential real estate. Within commercial real estate, I'm sure a lot of the participants are aware about REITs as an investment option. They're listed on the stock exchanges. Roughly, you call it 5 to 6% per annum yields today, roughly 4% kind of capital appreciation, taking total returns to investors in the range of 8 to 10% pre-tax and roughly 7 to 9% post-tax basis. So that's the broad math on the REIT side. Advantages is that it is listed, it is relatively liquid for smaller ticket sizes. But of course, these are historical portfolios built by sponsors who wanted to exit these assets over a period of time. So that's one good option for investors. Going forward, there would be the option of SM REITs, which is small and medium-sized REITs. Historically, a lot of the capital in this space was deployed through the fractional platforms. This is a very interesting asset class going forward, which again will have similar numbers to that of the REITs. At a higher end, very large ultra family offices could directly invest into physical assets, but typically investors have invested in floors in buildings, and of course it requires management effort to operate it as well as to lease out the particular asset. And of course, this requires a certain minimum level of ticket size, which could anywhere be minimum 10 to 20 crores, I would say, for even a decent size unit in any of the larger cities. As compared to that, what we are going to talk about is investing in this asset class through AIFs, alternative investment funds, which are category 2 AIFs, where the underlying ownership is that of the assets, physical assets, which is housed in SPVs, and then the SPVs are owned by the AIF. And we will get into details. Of course, there are benefits of centralized management, specialized management for this. And on a taxation basis, like we've discussed, there are the advantages of exiting the equity in these SPVs and getting the tax rate, favorable tax rate basis for that. On the other hand, on the residential side, of course, everybody's familiar with direct ownership of apartments or units, and then Either it could be rental basis, but then the rental yields typically are much lower at like 2 to 3%, or a lot of the investors try and purchase under construction, which is at a discount, and then gunning for much higher capital appreciation. But of course, there is a risk factor in terms of completion, in terms of delays, etc., which one needs to factor in. Or the other alternative, which happens on the real estate side for AIFs, is real estate lending, which is essentially lending to developers which are typically at a land stage or under development stage, where it's a high yield interest coupon, which is given in the form of debt to developers, and that interest is passed on to the investors. So that's the overall gamut in terms of commercial real estate, which is there. And in terms of this presentation is largely focused around AIF investing in commercial real estate, specifically completed commercial real estate. So within commercial properties and completed commercial properties, essentially the sources of IRR or returns are, I would say, four. One is the base rental yield, which in today's market would anywhere be from 8 to 9% for a leased asset. If one is looking at a vacant asset today, then the capitalization rate, the cap rate, would be in the range of 8 to 10%. Plus, there would be capital appreciation of on a base level, which is sort of linked to the rental appreciation, which would be roughly in the range, on an average, would be, call it about 4.5 to 5% per annum. But of course, over a period of time, this gets determined by the demand and supply for office real estate in a particular sector. On an average, it may be 5%, but on a cycle to cycle basis, it could be 0% in worst case, I've seen, to much higher of like 10%. So really, as a fund manager, a lot of our work is to study the demand and supply in different locations and see which cities are best placed over the next cycle, over the next 5 years, from a capital appreciation perspective and a rental appreciation perspective. And within cities, of course, also which micro markets are where the demand is high from tenant perspective and supply is constrained, and which will really throw up the capital appreciation. This asset class typically, because it generates consistent cash flows, one is able to leverage against this asset at an SPV level. And therefore, if the unlevered IRR, which is rental yield plus capital appreciation, is, call it 14 odd %, and the cost of borrowing from the debt is at 9%. So the spread of 14 minus 9%, the 5% spread, typically will result in an equity kicker, an equity benefit of another 4 to 5%. So the 14% of unlevered IRR would sort of translate to roughly like a 18 odd %, 18 to 19% kind of a levered IRR on an equity IRR or a gross IRR to the investors. On top of this, the business plan for somebody like us is to do value add on the operating side for the properties, which means increasing the occupancies, lease up of these assets, repositioning of the assets, buying older assets, doing capital expenditure improvements on those assets, repositioning the assets, getting green certifications, putting in solar panels, changing the tenant mix, changing the efficiencies. So operational value add is clearly one important parameter which can boost these returns in future. And of course, we are talking of all this in the space where we are talking of completed assets, really, where the underlying assets are already completed. These are post-occupancy basis. And getting into more details in terms of, on a macro level, how is commercial real estate really shaping up today? There are a few important factors that one needs to consider. The context, of course, is that India continues to be one of the fastest growing countries, and a sector like this really plays to the strength of India, which is export of services. And that's a great macro factor to be in. Interest rates is the other important factor, which is very relevant. Most analysts, economists would say that we are at a peak of the interest rate cycle. Of course, one may argue as to whether the rate cycle cut may happen after 6 months or 1 year, but at some point in time, it's likely to have more likely to happen rather than not. And that would again be good tailwinds for this particular sector. Because one is, of course, the interest cost goes down, but importantly, the capitalization rate on exit is likely to be much better. In terms of, if you can see this particular graph, which where the cursor is hovering, it's a fairly diversified demand base across different cities as well as different industry uses, which is a great thing from an India perspective, because that mitigates the risk to some extent. In terms of office, clearly the demand supply is looking very positive, because what's happening is that there is a lot of demand from the global capability centers. This is sort of an indicative list of tenants which is there typically in this asset class. So essentially the credit quality is very high. So the global capability centers continue to grow very fast in India. They are now almost 50% of the office demand in the country. Whereas on the supply side, the supply has got fairly consolidated, because typically not too many players. Typically, most of the supply is restricted to top 10 developers in the country, who have equity and debt, access to debt, so put up these assets. So on a macro perspective, because the demand is being taken care of by BFSI, by global capability centers, as well as on the manufacturing push, and the supply being consolidated, the macro fundamentals for office real estate are looking good. Clearly, India has moved away from work from home to a more hybrid, more work from office culture in general, as well as the employers are pushing for it. Also, what has happened is that the amount of hiring that happened during the COVID period, as well as post that, is been phenomenal. So, private sector banks, for example, they've grown by over 40% over the last 4 years, but the real estate footprint has not increased as much. So as now companies sort of move back to offices or more towards offices, clearly the real estate footprint is increasing as well. In terms of our strategy within commercial real estate sector is to focus on completed assets. So essentially, the sector asset class can be played at a land aggregation level, at a at an approval level, or even greenfield level. But as a fund house in general, we are focusing more towards completed asset acquisition, which really avoids 80-90% of the sector risk. So we are able to bypass 80-90% of the risk, because most of the delays and issues sort of happen during development stage. In terms of city focus, really what we are looking at, we are focusing on the larger cities, which means Mumbai and Delhi as primary sort of drivers, because we believe the rental cycle would be a lot more positive for Mumbai and Delhi at this stage. But Bangalore, Hyderabad, of course, continue to be large markets overall from a demand perspective. But juxtaposed with the supply side, we think cities like Mumbai and Delhi are best placed, followed by Bangalore, Pune, and Chennai in terms of the markets. Within those, of course, we have strong views in terms of which micro markets, which corridors will work for us, because we are extremely focused on the demand and supply side within micro markets, because again, we are trying to catch the rental growth, which is very important from an IRR perspective for us. Of course, an important part of any private investment is the exit strategy, which is very important. In terms of the potential buyers for these assets, one is looking at towards large family offices, club of investors who are able to buy these assets once the value add has been done and the assets are leased out. There are other pool vehicles, which could be AIFs, this could be foreign investors who are likely to buy some of these assets from us. REITs in India, again, as there are already 4 large REITs in the country, including 3 on the office, 1 on the retail side. SM REITs is a new concept which SEBI has approved earlier this year. The first issuance is under process. Most analysts are predicting massive amount of growth on the capital raising side through the SM REIT, the small and medium-sized REIT platform going forward, which will augur well for returns from this for the current set of investors into the strategy. Some other new sort of buyers that have been emerging over the last few years are insurance companies, for example, because they have long-term liabilities and they need longer dated assets. So an asset class like this makes a lot of sense for them. In the past, I have exited directly to tenants who are occupiers for units or corporates. So that's another set of buyers for this particular asset. And like I said, in each city, we are focused in terms of which micro markets to be investing in. We are looking for larger micro markets with lesser vacancies, uh, uh, and because that's where, so the combination of two is really what we're looking for, which is a not a very small market, doesn't have high vacancies. That's really would be the sweet spot for us within these cities to invest in. The other part of the strategy really is in terms of what is the operational value add. That really is the competitive advantage in a business like this, where a lot of the return really is getting generated irrespective of the market, right? So if you're able to buy assets under SARFAESI, under NCLT, under corporate insolvency resolution process, of course it's a skill by itself. One needs long-term orientation to crack these deals, which is something we've done in the past. Our current deal pipeline also has deals of this nature. We are one of the few firms who are focused on these kind of transactions, which is assets under insolvency, where banks really are, or creditors are selling these particular assets. The other leg on the return for us is the operations value add, which I said earlier, is in terms of working around with the efficiency for the particular units, in terms of the lease up for the areas. It could be in terms of operational improvement for the assets, getting green certification, creation of new amenity space, for example. ESG improvements is very, very important factor for tenants as well as investors in this particular case. Overall, we are very focused in terms of what is the per square feet price we are paying for an asset like this, because ultimately the entry price would really determine the returns for investors on this. And in terms of overall market size, the transaction type of transactions, we are really focused on the mid market, which basically means 100 to 500 crore asset value. That's where we think there is least competition today, because the larger funds are not interested in this kind of a deal size, as well as the family offices typically are restricting themselves to sub 100 crore kind of single transactions which are there. And therefore, if any transaction, especially if a transaction requires any kind of a value add, that's something which is typically not highly contested. Risk factors, of course, is something which is very important. One needs to understand. So I think in this business, in this asset class, leasing risk really is the number one risk factor here, where an asset can become vacant, partly vacant, and then there is a downtime required to release the particular asset. And therefore, to mitigate this strategy, what we are doing really is restricting ourselves to the top cities where 80-90% of the demand exists. We are restricting ourselves to corridors within those cities which are in high demand from the tenant side, and in fact have paucity of supply to some extent. And these are assets, these are buildings which have been leased to tenants in the past. So we are weeding out assets where there are fundamental issues which can't be leased out. So essentially, if a location is something which is leasable and an asset which is leasable, we don't mind taking the leasing risk on some of these assets, because we have the ability to lease this asset directly through tenants, through the past network. So really, as long as we understand and we are able to manage this particular thing, it's a great asset class to be in, because the tenant quality is very high. These are completed assets, and one is really getting 8 to 9% yields plus roughly like a 5% appreciation plus leverage benefit to hold these assets, to really provide capital, long-term capital to the high quality of tenants which I mentioned in the past. And exit risk, of course, one is taking care of by ensuring the fact that, again, we are in the right cities, the right micro markets. These are assets which are leased to good quality tenants, and so these are the basic fundamentals which have to be taken care of to be able to perform in this particular asset class, which is what really we've been able to demonstrate over a very long period of time of 20 years. This is a standard structure on the AIF structure side, where essentially investors come into the scheme of a particular fund, which is registered with SEBI. Typically, you would have 4 or 5 SPVs, which are there, which these are private limited companies typically, or could also be LLPs. And then the asset, each SPV owns a single asset. As far as the scheme is concerned, it is managed by the investment manager, who's also typically the sponsor, or it could be a group company which would be a sponsor, and that sponsor would have investment in the fund. And of course, there are statutory service providers like the trustee, custodian, R&T agency, which would be there. So this, in a nutshell, is about the opportunity for commercial real estate in AIFs, and in terms of this. Just to summarize, in terms of the presentation, what we're really saying is, within the fixed income spectrum, it fits well because there is a growth element to it, which is tax efficient, and in terms of the underlying asset quality is for completed assets. There is no development risk. There is no credit risk in the sense that these are not loans, these are asset ownership, and which are leased typically to high quality tenants, and for which essentially one is getting roughly like a 18% kind of a gross IRR. In terms of net IRR, depending on what the fee structure, etc., is, it could anywhere be somewhere around like 13% or so, and on a post-tax basis, anywhere from, call it like 11 to 12% is the target IRR range. So that is in terms of the summary for the presentation. Happy to start with the Q&A.
If anyone has any questions for Mitesh, you can drop them in the chat. There's a question. Santosh is asking, I'm told that developer financing operates at around the same IRR. Any reason why restructuring is your choice?
Yes, so that's a very valid question. So really, as an investor, one has to see as to where the capital is getting allocated, what is the time frame, and what are the risks involved in this. Overall returns, gross level returns, I would say, this strategy, which is asset ownership for completed commercial real estate and high yield loans to developers, the gross IRRs are more or less same. There are three key differences. One, fundamentally on the tax side, interest gets fully taxed, whereas a product like ownership of completed real estate is much lower tax because a lot of it is long-term capital gains tax rate. So on a post-tax basis, returns is really what matters to investors, and that's what the call should ideally be based on. That's one. Second important point is in terms of time frame, asset ownership. Typically, the money would compound for, call it 4 to 5 years. In a loans strategy, especially to high yield loans to developers, typically the money would sort of come back in, you call it 18 to 24 months. So the compounding impact is much lesser. That's the second point. The third important point is in terms of the risk that one is taking. On one side, completed commercial real estate, by definition, there is no development risk. It is completed real estate, whereas developer funding or private credit is typically under development or land level risk that one is taking. And these are loans to developers. It's not asset ownership. So those are the three key points that one has to see. And of course, there is no right or wrong answer. It's just a different risk return spectrum. And also the other thing, I think, in terms of historically what has happened in the last, call it 5-year, 10-year, 20-year period, where lending to developers is definitely a tougher business as such. And of course, there are a few funds who've done it very successfully, and some others who've struggled with it. But that's really where the manager selection becomes very important, and the business selection becomes very important.
Next question is, do you arrange the insurance on market value basis as the same is not available in Indian market? How will you protect the asset in case of complete property loss due to natural calamity?
So that's a very good question. So typically one does get loss of rent as an insurance policy, and essentially if one would really, in a scenario like that, would have to take that insurance policy, which is for the next many years, and assume that one would be able to redevelop the asset essentially during this particular period. So the loss of rent policy would kick in and compensate for the loss of rent till the property gets redeveloped.
Last question is, you mentioned about SME rates. Do you see any regulatory challenges in the current regulations, which is restricting the launch of SME rates? And when will we see a number of SME REITs being launched?
I think that's a very promising sector, a new source, a new avenue for pooling of retail investment or retail capital into this particular sector. And SEBI is quite interested to sort of promote that. But like any new regulation, things take time, and there are, I'm sure issues to be solved, clarifications to be given. SEBI has been quite proactive in this, and uh, it looks like this particular sector will move forward. Even in the main REITs, for example, the initial regulations, it took at least 4 to 5 years for really the main REIT sort of to be set up and up and running. So in that sense, at least you call it like a couple of years or so would be the kind of time period. But already the first SM REIT is under process, and I think I would estimate it would take what couple of years for this market to really have maybe 3 or 4 SM REITs, which would really then sort of test out this particular case. But see, that's essentially a regulation sandbox which is there. If sort of one particular thing doesn't take off in a way, the capital would still sort of flow in another way, through another channel, to another way. So really that's because the returns are there to be made in this particular sector. The risk return sort of matrix sort of still being there, investors would find a way to sort of access this particular capital. So if it could still move through the main REIT model, for example, the larger investors could come through the AIF route.
That was all for the questions. Thank you so much, Mitesh, for doing this and sharing your expertise and giving us an in-depth look at the commercial real estate investment space in India. And everyone who joined us today, thank you so much for your time and engagement. And we hope this session has been extremely informative for you too. So thank you so much.
Thank you. Thanks for the opportunity.
All right. Thank you.